Welcome to Value Vest Daily. Well, on March 22nd, 2026, the Federal Reserve dropped a bombshell on the markets. Now, on the surface, they kept interest rates the same. But trust me, their message was anything but steady. Chair Powell basically came out and made it crystal clear. With inflation roaring back to life thanks to a new oil shock, any hope you had for rate cuts, yeah, that's been put on ice. We're seeing stocks tumble and oil prices go through the roof. But here's the thing. What if all this chaos is actually creating a massive opportunity? In this deep dive, we're going to unpack exactly what the Fed's new hawkish stance means, why it's happening right now, and how it's forcing smart investors to completely rethink their playbook for the rest of the year.
Okay, before we get into the thick of it, just our usual quick reminder. This is all for educational and informational purposes. It is absolutely not financial or tax advice. You should always consult with a qualified professional before making any big decisions. All right, let's do this.
So let's start with the big question, right? How on earth can a conflict happening thousands of miles away reach out and directly shake up your investment portfolio? Well, the answer is this incredible economic chain reaction. And it's a story that really unfolds in two parts.
And that story starts with what a lot of economists are now calling the double shock. You can think of it like a 1-2 punch that's hammering the global economy right now. These are two powerful, simultaneous pressures that are basically backing the Federal Reserve into a corner, and it's leaving them with very few good options on the table. The first punch and the most immediate shock is the price of oil. And look, this isn't just some minor blip. Brent crude is sitting around $110 a barrel, and we've seen spikes go even higher. Why? It's all because of this escalating conflict that's messing with supply through the Strait of Hormuz. I mean, this is a critical choke point where a massive chunk of the world's oil supply has to pass through. We're talking millions of barrels a day. In some physical markets, prices have hit an insane $150. This isn't just a number, you know? It's like a direct tax on the entire global economy. It makes everything more expensive, from shipping stuff across the ocean to just filling up your car. Now for the second punch. The thing is, inflation was already a problem before oil prices went crazy. The latest PCE number, that's the Personal Consumption Expenditures Index, it's the one the Fed really watches closely, came in at 2.8%. And if you strip out the crazy swings in food and energy, that core number is even hotter, closer to 3%. A big driver for this has been the ongoing cost of tariffs on things we import. So you see, the Fed was already in a tough fight, and this oil shock just poured gasoline all over that fire. Okay, so you've got stubbornly high inflation, right? Then you throw a massive energy price shock right on top of it. What's a central bank supposed to do? Well, that brings us to the Fed's recent decision, what everyone on Wall Street is calling a hawkish hold. They're not actually raising rates yet, but they are slamming the brakes hard on any idea that rate cuts are coming soon. Officially, the outcome of the March 18th meeting was no change. The federal funds rate is still in that 3.50% to 3.75% range. But the rate itself, that's only half the story. The real news was in the Fed's tone, in their forecasts, in their whole message to the market. And for a market that was desperately hoping for rate cuts to make borrowing cheaper and keep the party going, that message was like a bucket of ice water to the face. So you hear this word hawkish getting thrown around a lot. What does it actually mean? Well, it's pretty simple. It's a policy stance that puts fighting inflation at the very top of the list, above everything else. A hawkish Fed is totally willing to keep interest rates high to cool prices down, even if that means the economy slows down a bit. It's a tough balancing act, and right now, the Fed is leaning all its weight on the side of stomping out inflation. And we heard this hawkish tone straight from the horse's mouth. In his press conference, Chair Jerome Powell really didn't pull any punches. He looked right at that oil shock and said, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration. That last part, that uncertainty, is everything. The Fed sees this huge new risk, and their gut reaction is to be cautious, to wait and see what happens, not to jump the gun on making money cheaper. And this isn't just talk. They're actually changing their official numbers. Just look at this table of their own inflation forecasts. A few months back, they thought 2026 inflation would land around 2.4%. Now, they've bumped that all the way up to 2.7%. That might not sound like a huge jump, but for the Fed, that's a massive revision. It's them telling us in their own data that they think the inflation problem just got a lot worse. And that justifies their whole cautious approach. So let's just quickly boil it all down. What are the big takeaways from that meeting? Number one, rates are the same, but the vibe is way more cautious. They're telling us inflation is elevated and that oil is a huge risk. This makes the whole path to rate cuts way more foggy.
The bottom line from this meeting is really simple. The era of easy money is not coming back anytime soon.
So, as you can probably guess, when the most powerful central bank in the world signals higher rates for longer right in the middle of a geopolitical crisis, well, the financial markets don't exactly take that news lying down. The reaction was fast, it was brutal, and it sent shockwaves through trading floors everywhere. The fallout was pretty much immediate. In the days right after the announcement, markets just sold off, and hard. The S&P 500 dropped 1.5%. The tech-heavy Nasdaq, it fell even further. And that makes total sense, because those high-growth tech stocks are usually the most sensitive to interest rate fears. We're going to break that down in just a sec. This whole sell-off put the market on pace for its fourth losing week in a row, a really clear sign that investors were running away from risk. And what's really driving this fear is the return of this really nasty economic monster of a word, stagflation. It's this toxic cocktail of a stagnant economy, meaning slow or no growth, mixed with high inflation. And high oil prices create the absolute perfect storm for this. See, they act like a brake on the economy by jacking up costs for everyone, while at the same time, they push prices higher. And because inflation is so high, the Fed can't just ride in and save the day by cutting interest rates. It's the exact economic nightmare that's gripping the market right now.
And it's not just stocks either. The bond market is flashing the exact same warning sign. The yield, or the interest rate, on the 10-year Treasury note, which is this crucial benchmark for everything from mortgages to car loans, it's been climbing. And when that yield goes up, it means investors are demanding more interest to protect their money from inflation over the long haul. So in other words, the bond market is basically screaming, confirming what the stock market is afraid of. Higher rates are here to stay for a while.
Okay, so we've laid out the problem. We've got a hawkish Fed. We've got an oil shock. We've got these rising fears of stagflation. It sounds pretty bleak, I know. But here's the cool part. Inside every market panic, a new strategy starts to bubble up. And the one that's really gaining steam right now is something called the value rotation. Let's break down exactly what that is. The logic here is actually pretty simple. Think about it like this. A dollar that someone promises you 10 years from now is worth less than a dollar you have in your hand today, right? Well, how much less is determined by interest rates. When rates are high, that future dollar becomes worth a lot less in today's terms. And this just mathematically crushes the present-day value of companies whose biggest profits are way out in the future. You know, like a lot of those high-flying tech stocks. Their potential is still there, sure, but it's just worth less in a high-rate world. And this is what we call a value rotation. It's this big strategic shift where investors start selling those growth stocks that are getting hammered by high rates, and they move that money into value stocks. These are usually your more stable, boring, established companies that are making real profits right now. They're seen as being much better equipped to ride out an economic storm. It's basically a flight to safety and quality. And this really shows you the difference side by side. On one hand, you have the high-growth sectors. They're vulnerable because their value is all tied up in promises of what they'll earn in the future. On the other side, you have the value and defensive sectors. They're more resilient because they're churning out strong profits and cash flow today. We're talking about companies that provide stuff people need no matter what. Consumer staples, healthcare, utilities, things you buy even when the economy stinks. So where specifically might you start looking for this kind of value? Well, the strategy points to a few key places. First, you've got those classic defensive sectors. Second, you can look for quality dividend growers. A company that can raise its dividend year after year is basically shouting that it's financially strong. Third, and this is so important in an inflationary world, you look for companies with pricing power. Think of a brand so powerful it can raise its prices and people will still buy its stuff. And finally, you can even be picky within the energy sector itself and focus on the producers with strong books who can actually profit from these higher prices. Now look, this is not about trying to perfectly time the bottom of the market. That's a fool's game. A much more disciplined way to go about it is something called dollar cost averaging. The idea is simple. You identify those quality companies, and then you just invest a set amount of money at regular times. When the market dips, your fixed investment actually buys you more shares, which lowers your average cost over time. It's an awesome way to take emotion out of the driver's seat and just focus on the long-term strength of a business, not the short-term panic. And it's really important to remember that while every crisis feels totally new and terrifying, there's often a historical pattern to these things. It usually starts with some kind of shock that creates fear and a sell-off. Then the central bank reacts, which can make things even more uncertain at first. But as the market starts to digest all this new information, it begins to price in the risk. Valuations for solid, strong companies start to look really attractive. And historically, once the worst of the uncertainty starts to pass, it's those quality names that tend to lead the whole recovery. Of course, we have to be honest about the risks. The big one is that the conflict gets even worse, pushing oil prices into truly crazy territory. That could really deepen those stagflation fears and maybe even push any talk of Fed rate cuts all the way into 2027. But on the flip side, if the conflict cools down, or if some of those tariffs get eased, the market could bounce back incredibly fast. The bottom line is this. Yeah, the current environment is full of uncertainty, but for patient, long-term investors who are focused on quality, this fear-driven dip could actually be a major opportunity.
And that really just leaves us with one final question to think about. In a world that seems to be getting more unstable by the day, where just sitting in cash means you're losing your buying power to inflation, maybe the greatest risk is not taking a calculated one at all. Please subscribe, like, and share Value Vest Daily for daily learning opportunities before you put your money to work. And one more thing, please put in a comment if you want us to deep dive into any specific high-risk/reward opportunities.